Group 15 presents the presentation video about the paper Earnings Quality in UK Private Firms, Comparative Loss Recognition Timeliness by Bal and Shivakumar from 2005. They investigated if private company financial reporting is of lower quality than the quality at public companies. An important attribute of financial reporting quality is timely loss recognition. To explain the concept, we will come up with an example. There are two comparable firms in the UK, one private, one public, but both operate in the same industry and recognize losses this financial year. UK private and public companies face substantially equivalent regulation on auditing, accounting standards and taxes, but due to different market demand and regulation, Bal and Shivakumar emphasize that the private company financial reporting is of lower quality. They expect that timely loss recognition is less relevant in private companies than in public companies. All private and public companies are required to file annual financial statements that comply with the same accounting standards. All financial statements must be audited, and both companies are filed to the same tax laws. Nevertheless, the market for financial reporting differs substantially between private and public companies. Relative to public companies, the demand for financial reporting in private companies arises relatively less from reducing information asymmetry between managers and other parties, like lenders, shareholders, suppliers, and customers, and relatively more from other sources, like tax, dividend, and compensation payment policies. With other words, private companies communicate more privately. The paper used one important attribute of reporting quality, timeliness in financial statements recognition of economic losses. Timely loss recognition increases financial statements usefulness. Timely loss recognition implies timely revision of all financial statement variables and all financial ratios based on them. Accounting recognition of income is asymmetric because it can occur in two ways: deferred and timely recognition. Deferred recognition ignores revisions in expectations and awaits the realization of the cash flows. Timely recognition incorporates unrealized gains or losses in income on an accrued basis. Accountants are reluctant to recognize the information managers possess about future cash flows when it is unobservable to external parties and unverifiable. Financial reporting normally modifies the revenue recognition rules by adopting a lower verification standard for information about economic losses than for economic gains. That's the idea of conservatism. Anticipate no future profit, but anticipate all losses. All information leads to the following hypothesis: there is less reversal of income decreases in private company than in public companies. The paper uses two models for measuring the earnings quality. The first one is Bazu's time series test of timeliness in loss recognition based on his paper from 1997. This test is based on conditional conservatism, delay revenue recognition by one period, or subtract a constant from earnings every period, independent of current gains or losses. For example, reflect bad news more quickly than good news. Because Bazu's serial dependence model has limitations, the accrual-based test of loss recognition from Gichov from 1998 is added. The expectation is more demand for quality auditing by public firms because private firms communicate more privately. The difference between public and private company timeliness occurs consistently in both earnings change-based and accruals-based tests of quality. Back to our example. The conclusion of this paper indicates that, despite being prepared under the same regulations, the private company recognizes the loss at a later moment, and so their earnings quality is lower.
Created using Powtoon.